Hello everyone. I want to run through our final exam paper, and this is on chapter 26. I know when you look at the practice problem, it says chapter 25. Don't be worried about that or concerned about it, because the last edition that this came from went up to 25 chapters, and they ended up running an extra chapter. They took the last chapter and split it out into 2 chapters. So technically speaking, this is chapter 26, so I'll change that to chapter 26. So, okay, now it's official. Practice problem, chapter 26. Okay, so here we go. We have an analysis computation of payback, accounting rate of return, and net present value. Most company has an opportunity to invest in 1 or 2 projects. Now I start highlighting. Project Y requires a $350,000 investment for the new machinery, 4-year life, no salvage value. So here's Project Y for new machinery, 4-year, no salvage value, okay? And then if I had a second colored highlighter, I'd use that for the next part. Project Z requires $350,000, same dollar amount investment, but this time watch, it's for 3-year, no salvage value. So you gotta keep your head on, and make sure you're comparing 4-year to 3-year. So Project Z, $350,000 investment, 3 years, no salvage value. Okay, the 2 projects yield the following predicted annual results. So these are the income statements for Project Y and for Project Z. Alrighty, and of course we have it broken out. We have expenses of direct material, labor, overhead, selling, administration, and total expenses. We get the pre-tax income taxes of 30%, and net income. Okay, so that's like a very typical income statement. First, compute each project's annual expected net cash flows, round to the nearest dollar. All right, now cash flow is not in here, but if you remember from the latter chapter in Accounting 112, Financial Accounting, when we did the statement of cash flows, we would wind up taking net income and then adding back into it things that were non-cash items, like gain, loss. Those are non-cash items. Another non-cash was depreciation. Guess what? You can figure out the depreciation of these things. So Project Y, it has a $350,000 investment, okay? And of course, if you remember from way back, beginning of Accounting 112, that you subtract out the salvage value, and then you divide that by the number of years of useful life. So you divide that by 4 years, and you'll come up with $87,500. Same thing for Project Z. The investment is $350,000. Again, there's no salvage value, so don't worry about it. You divide that by the number of useful lives, which is 3 years, and you come out with $116,667. Now I rounded this out because otherwise there'll be a repeating decimal point, but I'm just going to the nearest dollar because it said here nearest dollar, okay? And then I'm going to add these back to net income to get my cash flows. So I pull out my calculator. My Project Y net income is $56,000, and I'm going to add $87,000. And I have too many zeros here. Never mind. 87,500. 87,500. Whoops. Let's see. Do that again. 56,000 plus 87,500, and that gives me 143,500. So for answer to number 1, payback, or I'm sorry, cash flow. I will need cash flow to do payback, so if you think this is a meaningless exercise, you really need this number for the next problems that are coming up. So you're going to have 56,000 plus your depreciation expense for the year of $87,500. That's equal to $143,500. Okay, project Z, I had net income of $36,400. I add my depreciation expense of $116,667, and 36,400 plus 116,667, I get 153,067. Okay, so that's my payback. I'm sorry, I'm getting mixed up again. That's my cash flow. All right, now payback. Let's get into that now that I keep talking about it. That's the next question here. Determine each project's payback period, round to the nearest 2 decimals. So I'm going to take basically the cost of my investment, which is the $350,000, okay, for both of them, and I need to figure out how many years it'll take to recover that $350,000 for both projects. So I'm going to divide this by the cash flow each year. So my yearly cash flow is going to be $143,500. My cash flow for Z is $153,067. Okay, divide 350, divide by 143,500, and I get 2.439, so I'm going to round up to 2.44 years. And this one, 350 divided by 153,067, and I get 2.286, or I'm going to round it up to 2.29 years. Okay? All right, very good. Next on the agenda, number 3. I need to calculate the accounting rate of return for each project. Again, round percentage return to 1 decimal, okay? So the way I calculate this is I take net income after tax. That's what it says in the book, net income after tax. And so the net income after tax is your income statement. Here's income tax right here. So the income after tax is $56,000 and $36,004. So we'll start with that. The numerator has $56,000 and $36,004. And then it's divided by the annual average investment. What the heck does that mean? Well, what it's saying is that you take your investment and whatever it averages out on an annual basis, you add up all the book value of that asset, divide by the number of occurrences that happens, and there you get your answer. So it's the same, folks, it's the same idea as what we did in Accounting 112, the very last chapter when we're doing financial statement analysis. We did like inventory and accounts receivable when we were doing the days sales and inventory, or the turnover rather for inventory and the turnover for accounts receivable. You had to have average accounts receivable or average inventory. So you took the beginning of the year inventory and the end of the year inventory, you add them up, divide by 2 to get an average inventory, okay? Well, you do the same thing here too. We know that the book value of our asset when we first bought it was $350,000. We also know that at the end of the life it's going to be a zero value, so it's going to be $350,000 plus 0 divided by 2. And the same thing over here. 350,000 plus 0, because it too had no salvage value, divided by 2. Okay? And then what I get for this first answer is going to be, well, let's see what 350,000 divided by 2 comes out to be 175,000. Okay, good. So 56,000 divided by 175,000 is 0.32, or 32%. This one is going to be 36,004 divided by 175,000 is going to be 0.208, and that's going to be 20.8%. Okay, and you carry it out to 1 decimal point. Okay, very good.